Welcome back to the Investing on a 9 to 5 channel. It's your boy, the Dividend Dog. On tonight's video, we're going to be talking about a real estate company that I think is undervalued right now. It may fit your portfolio, it may not, but by the end of this video, we'll know if it does or not, right? But before we do that, I just wanted to give you guys a shout out there for getting us over 50 subscribers on the channel. If you're new out there, just first time checking out the channel, don't forget to hit the like and subscribe button so you don't miss out on any future content. So we're going to dive right in, guys, because it's Saturday night and I know you probably got things to do, or you're probably just scrolling on YouTube and you've somehow figured out how to get on this YouTube channel to look at Self. So who is Self and what they are and who they do and how they make their money? So as you guys can see, they are in the real estate sector, specialize in self-storage. So I'll give you guys a couple facts about the self-storage real estate sector. About 10% of the U.S. population actually uses, rent storage. There's 50,000 self-storage facilities just located in the U.S. Self-storage REITs, Self, they operate some of the most balance sheets in the real estate market. And also, guys, 40% of the renters stay over 24 months. So that's good revenue within the first couple of years, and then possibly continued revenue as well. So on, after, they are been in tennis there for over the first 2 years. So let's jump right in and take a look at Self and see who they are. So they are at 493 on close of Friday. We're going to go over here and look at the returns. You guys know here on the page, we'll just go look at the returns, look at the valuation, look at growth, and so on. We'll check the dividend out. Then we'll go check out their investor relations page so we can get a little bit more into depth on who they are. So as you guys can see, from a return standpoint, they are returning at 38.2 for the last 5 years, 3 years, 37.8, and in the past year to date, right now they're at 9.2 return. But as you can see, S&P 500 wise, they've had a little bit better returns up to the 5 year compared to the S&P, but compared to their industry, they're returning as well, except up to the 5 years. So this is a small company with the market cap of only 54 million. So they're very, very small, 28 employees, at 12 million in sales. So very, very small company. Like I said, we don't know if it will fit your portfolio or not. This is a small company, but it's very undervalued from metrics here on Stock Rover. Stock Rover's got the margin of safety at 19%. So it's under value of what they think it's worth right now. And it's worth at 586. Right now it's at 493. So you got a forward price earnings at 21.4. Price earnings at 17. So people, it's an expensive, they're paying a lot for the stock. So, compared to their industry, but the returns are, for growth and sales and earnings per share are very, very, very competitive as well. So, for this type of stock at 493, it's 19% under value of a margin of safety here. Not financial advice, obviously. It's just my hypothetical random thoughts here on a Saturday night. But with a 5.9 dividend yield, we don't take really in consideration that payout ratio, but we're going to look at the FFO, the funds from operation, which in returns could be how much cash flow they're generating as a real estate investment trust company. And also one thing too, guys, don't forget REITs. They have to pay 90% of their income to investors in form of a dividend. So this is a huge thing as to why, being a dividend investor in real estate it could be for your portfolio or it can't be. So dividend for the past year has been increased 11.5%. So it's beating the CPI, index inflation. The past 2 years is 3.7. So they're increasing the dividend, heavily, within the last year to get it at a 5.9 yield. Now I'm not, I don't like buying companies who are high yielding, but for this year, between 2 and 5%, 5% is my highest that I would go if I'm gonna full on this, own a stock long term. I don't have any shares in this company as of right now. Thinking about it, I added it to my little watch list here. But what we're gonna do next, guys, is we're gonna jump down and see who they are. So as we all know, they're a real estate investment trust. This right here is on their investors relations page. You can go on it on their website, and it will take you. You can go to the investors page, and it has a presentation for you guys where they'll give you a little bit more background history on who they are, and basically, a visual aspect of it. So as you can see, they own and manage 13 self-storage properties with about 968,000 square feet of product, or of space. Now, just to give you guys an example of how small they are, what they with compared to like PSA, not public service announcement, but public storage, you probably have seen those pop up in your neighborhoods. They have over 2,800 facilities, 200 million square feet, and their major markets are in major cities like LA, Miami, New York, and Seattle. Now, they seek to, have additional properties in highly effective professional management and best practices areas. So we'll go down and we'll see how they market their product, or not their product, but their businesses. So we'll go down and look at their the quarter three 22 highlights. So revenues are up. The funds from operation. Remember with the REIT, we have to look at the FFO and the AFFO to give a gauge on how much revenue is being generated. So as you can see, they're up relatively strong. Revenues, same store resorts, revenues up. Net operating income's up as well. Dividends, as you guys remember, they've increased it 11.5% this year. And their occupancy rate decreased to 89.6 from 93 at September 30, 2021. And as of November 8th, 2022, it was at 90.6. So they've increased it, from last year back to 90. It decreased to 89, but now it's at 90 now. And their average tenant stay is about 3 years at quarter end. So as you guys can see, this, like I said, they perform well. The revenues there is just a small, a small market cap, small REIT that that that's needed. I think strong companies like this that have spots, as you guys probably have seen in your neighborhoods. People, that are retiring, that may not need a bigger house, that like to travel a lot. They could take these storages to put their things in. People who are needing their RVs or their boats or anything like that. That millennials who don't want to have a huge house as well, or in there everyone's could be that's still living in apartments that hey, we have things that we in our spot that we may need to push out, and they may have to be in need of storage units. So they have a huge outlook for the next couple of years, all the way up to 2024, that the self storage unit is going to be expanding. U.S. household is going to be up to 10.6%. It's going to be 50,000 plus facilities. It's just, as you can see, the percentages for the outlook, that the more people that we have, the more storage that's going to be needed down the road. And they're continuously to have a high occupancy rate, meaning the tenants are staying longer. They're having very high demands for the for the self storage unit. And this is how they stack up against the competitors. So only 20% of the market is controlled by the large players like PSA, Public Storage, U-Haul, Q-Smart, Extra Storage Space. These are all storage units companies, and 71% of them are the self-storage ones that are independent, like the mom and pop operators, which self-storage, SELF, which they are mainly controlled in. Let's see. One thing too is I like how diverse their market is. So remember when I was telling you guys, PSA, they like to hit the main cities like New York, LA, Miami, Seattle. SELF Self, they target more the Northeast, Midwest, Southeast region. There you go, like near the metro areas. There are places that are like your suburb areas that have great highway exposure, that are easy accessible. They have strong markets. A highly competitive like suburban areas where a lot of professional people live, and a lot more diverse customers out there. And then also they know that the big players like PSA, they do not come out into the smaller areas, such as what they target. So it kind of protects them from the competition, but the competition's always still there knocking. And goes back to show as a good mixture of what they do. So they do have the drive up storage units. They also have obviously the all climate controlled inside, and then you got the outdoor area too, where you can do the boats, cars, and RVs. And then you also can, they have everything secured for customers, just so they can make sure everything's maintained. 24/7, kiosk rental, attentive customer service, and yeah. So guys, this is who they are. We'll jump over to the dividend section here from the investor relations page here, just so we can close off on the video. Let you guys get back to your fantastic Saturday night. Thank you for rocking with me if you've made it this far. So let's see. We got the dividends here. So since 2008, guys, the dividend has gone with reinvestment increased. It has gone from total returns gone from 26% to 139% return, guys. So once again, making sure we have that drip on, and look how much, you would have gained return just by reinvesting the dividend. And that's just as off as just one share. Imagine if you would have purchased 100 shares or 500 shares or 1,000 shares or however many, and continue to let that compound over time. Now I know the dividend increases look a little steady, not what it looks like. This not look as pretty as some of the other dividends that we look at here on the page, but as you can see, it's been steady, and that's been okay, long as there's been like no major dips here below the 26 marker here. Obviously we're back at 28 now, so I mean, it's back on a solid positive trajectory. And the global sector, market for the self storage REIT, I mean, it outperformed the total, VNQ, which is the real estate ETF or Vanguard. It outperformed that by 5% during the pandemic. So just by looking at that, just goes to show, not telling you to go out and buy it or add it to your portfolio, but it kind of just makes you think like, maybe, this little $4.93 stock could be added to my portfolio. Like I said, guys, it's a small cap stock, but it does have, a solid and, decent paying dividend that they're continuing. It looks like they're going to continue to grow. And, that, like I said, the self storage REIT real estate market is going to be on the rise here in the next couple of years, based off of some research. This could be my crazy hypothesis. I can be completely wrong, but thanks again, guys, for joining us here in the Investing on a 9 to 5 YouTube channel. It's your boy, the Dividend Dog. Don't forget to hit that like and subscribe button, and we'll catch you guys on the next video. I'm out.